With talks of a recession, many first-time homebuyers are wondering what this actually means for the housing market. We see mortgage rates shifting, home prices are starting to flatten, banks are tightening lending guidelines, especially when it comes to condos. So the question is, should you buy now or wait? Today's episode, we're breaking down how a recession could impact first-time homebuyers, the key factors to watch, and what you can do to prepare no matter what happens next.
The big question, Jeb, and what we're really going to try and answer today is, does a recession create home buying opportunities, or does it make it harder to become a homeowner? Most of the folks listening to the show are first-time buyers. We got a number of move-up buyers, but a lot of first-time buyers are saying, hey, is this the entry point? So when we look at it, recessions are generally disinflationary, if not outright deflationary, lower interest rates. Everyone loves lower interest rates. All of you watching, listening have been saying, hey, I just need rates to get lower so that affordability improves so I can jump into the market. But at the same time, we generally have higher unemployment, a weakening economy. People aren't feeling as good about their prospects. We're going to go through all of that data, but it really is one of your favorite words, Jeb. It's a bifurcated market for home buyers of when this happens, whether it's 6 months from now, 18 months from now, it is going to present an opportunity, but it won't present an opportunity for everyone. And we're going to walk through that.
Yeah. And so with that, Josh, there's, 5 or so economic factors that, we like to talk about or that we're going to talk about when it comes to recessions and what you can watch out for, right? So at the moment, we're not in a recession. The headlines are screaming that a recession is coming. I mean, hell, I thought we were headed into a recession 2 years ago just because of some of the data, and then everything changed. So let's talk about what we need to watch out for if we're looking at these recessionary signals and what we can do as a buyer to potentially take advantage of.
So let's start with GDP. The standard dictionary definition of a recession is 2 consecutive quarters of negative GDP. So the Atlanta Fed has a cool tool that people take out of context, misquote, misrepresent all of the time, but it's called their GDP now. It's a nowcast. All information that has come in to date, they put into a number and they project what's going to happen. So if you watch the live show regularly, if you're here and follow us, we talk about it. At the beginning of quarters for the last 2, 3, 4 years, it's vastly overstated what GDP is going to be. And then as more data comes in throughout the quarter, it gets pretty correct and kind of diverges or converges on what the actual number is by the end of the quarter. Well, right now, the GDP Now model estimates a 1.8% contraction in GDP for this quarter. Like that's huge, massive. And it was worse. What was it, like 2.8? It was at least negative 2.4. Yeah. It was over 2 negative. And we said, well, everybody chill out. This doesn't mean that the economy just fell off a cliff. It just means that the data at the beginning of the quarter here was heavily negative. I expect that to moderate. It may end up positive. Most people, Jeb, that we follow that really dig into GDP, Peter Bookvar, David Rosenberg, some of these guys, they said, hey, we've been running just below 3% the last 3 or 4 quarters, and it doesn't feel like a 3% economy. It feels like a 1.5, maybe a 2% economy. So now if we're seeing these numbers, that could be just what we're going to see. So if we had 1% growth, 0.8% growth, 1.5% growth for 2, 3, 4 quarters, that's going to feel vastly different than the last 5 years, despite the fact that it wouldn't technically qualify as a recession.
So what does it actually mean, Josh, when we say slower economic growth, right? If we're not coming in at 3%, we're coming in at 2 or 1 or even flat for that matter, what does that mean for the person out there in the economy that is being impacted?
So what are all of the things that go into it? It's the productivity of the entire country. So every employee, every company, what did they produce over the course of the gross domestic product? What did they produce? If you're producing less, you get paid less. So companies make less, employees make less, there's less overtime available, less bonuses at the end of the year. So from that perspective, it's a negative, right? If we talk about affordability, affordability is a measure of how far my household dollars go towards buying whatever we're trying to measure its affordability. So there's other things downstream of lower GDP. But if we're talking about that, lower GDP is not evenly distributed. Not everyone is impacted the same, but it's kind of like we talk about national home prices. Do those really matter, or does it matter what happens to you? Like if your company goes out of business and you lose your job, we could be in a garden variety mild recession, and that feels like a tragedy to you. Someone else may be in an industry that has done really positively. I have one of my VIP clients owns a janitorial service. While COVID at the beginning was bad for everyone, They doubled their business in like 3 months at the very beginning of COVID. It ended up positive for a lot of people, but just long way of saying it's not evenly distributed. Some of you, your business will benefit over the next 3, 4, 5 years. Your income goes up, interest rates go down because of a recession. You're like, this is the greatest thing ever. Other people will experience it very differently.
Yeah, and as businesses are impacted by slower economic growth, typically means fewer jobs available, right? Stagnant wages. They're not going to continue to raise wages, potentially hiring freezes. So maybe they're not firing people or getting ready people. I mean, as today, as we're starting to talk about this, a report came out this morning. Morgan Stanley is letting go of 2,000 people this month, right? So you see the slowing in the economy starting to happen. That's that North Carolina coming out into me again. It's just starting to happen again. And essentially, what it boils down to is, a slowing economy is going to impact everyone. It's going to impact businesses, but there's also some benefits to that, Josh, in that the Fed will likely start to lower the Fed funds rates. We're likely to see interest rates go lower because that stuff helps stimulate the economy. But with that, let's talk about the second factor.
But before we go the last thing you said made me think of this. Why is a recession or lower GDP disinflationary? For all of those same reasons. When the economy is going well and you feel really good in your job, your stocks are up, you get a raise 5, 6, 7% every year. People that sell you stuff feel okay about going, I got to raise my prices. I can raise my prices. Jeb will deal with it. Jeb will pay whatever the price is. On the flip side, when you're feeling less confident, your stocks are not up, all of that, you're feeling less confident. So they may try to pass that price increase on to you, and you go, piss off. I'm not paying that. And their sales go down. So it is generally disinflationary, if not outright deflationary.
I'm getting really close to that, Josh, when it comes to eating out. Dude, going out, 2 people, family of 5, right?
Your kids don't get to go with you?
No, not anymore. It's crazy. Like me and my son went the other night and ate hamburgers at I forget the name of the place here. Anyhow, new place. Dude, it was $50 for 2 of us to get a hamburger. Yeah. And I'm like, and no drinks. Like, what are we talking about here? Hamburgers and fries. Like, no, I'll stay home and eat.
So on that topic, just to put a bow on that, there's a saying that says the cure for high prices is high prices. So prices have gone up. They've got to a point where Jeb and his family are going, we're going to stay home and eat sandwiches. We're not doing this. So businesses will eventually get the note and go, people aren't coming in. And they'll start doing specials. They'll start doing sales for 2, 3, 4 years. Prices stay the same, even though your favorite restaurant has raised prices every year, sometimes multiple times a year. So it doesn't happen overnight. It doesn't feel good. We don't notice when prices don't go up for 5 years, but we've noticed when they go up every year for 5 years.
Absolutely. So take us into the second thing. This is kind of, following what we just said, consumer sentiment. What does that mean, Josh? What is consumer sentiment and how does it impact everything around it?
So it's a survey that the University of Michigan does. I believe they do it monthly. So this is updated fairly regularly. So we get regular reads on this. The Consumer Sentiment Index dropped to 57.9 in March. And you go, cool, what in the world does that mean? Well, it's the lowest level since November of 2022. And where were we in November 22? Right, dealing with this shock of high interest rates. My 0% interest rates have gone away and now they're 5, 6%. And everyone thought that was the end of the world. So consumers were looking at that going, this has changed. Something has changed and I don't feel as good about the future. And over the last few years, people have adjusted to that. Despite high inflation, consumer confidence remained relatively high. We've talked about this before. The prices are a level and we generally measure them relative to our income. If my income doubles and prices go up 20%, I really don't care because I'm making so much money that this is great. Well, if prices go up 10% and your income goes up 10%, you're feeling it. But if prices go up 10% and your income goes up 3%, you're absolutely feeling it. And that is where we are at right now. Interest rates have remained elevated. Inflation is not, it's actually, Jeb, over the last 3-4 months has moderated a lot. If we look at trueflation, if we look at a lot of the underlying elements of GDP, PCE and CPI, it has moderated a lot. I don't think we have an inflation problem right now. We do have a high price problem. And consumers, between low affordability because of high home prices, because of high interest rates, because of inflation in all goods and services, and now a slightly weakening jobs market where we're not seeing as big of year-over-year increases, consumers don't feel good. And they're telling the University of Michigan that our feelings about the next 1, 3, 5 years is not nearly as positive as it has been. And that is highly correlated to a downturn. The consumer is actually pretty good in aggregate of all the people in this survey of picking up what's coming next in the economy.
And we see that with the stock market, things like that, right? People start to get scared. They start to get a little worried, anxious about what's coming in the future, and they hold off on big purchases, right? I mean, we talked about this story. I don't know if it was on the live or on the last episode here, but a friend of mine had posted two different pictures of client interactions where one seller was pulling their home off the market. This is when the stock market dropped like 3 days in a row, right? We lost, I forget what the percentage was, but it was a big percentage. And one buyer just said, you know what, now's not the right time, right? So it is that mentality of people not being confident in what's coming. And that could impact not only the housing market, but how people interact with the housing market just in general.
100%. All of the things that fall into the like to have category start getting put off, delayed, if not put aside entirely. You may decide, hey, there's a couple of projects that I want to do around the house here, and it's $3,000, $4,000, $5,000 to do that. But I want to take a vacation, and it's $5,000 to do that. People say, well, I take the vacation, that's gone. That's money spent. If I stay and do some work around the house, well, now I'm going to have the benefit of that on a daily basis. So spending shifts to things that are more durable and more permanent, and things that are transient or voluntary, elective, they're going to put it off more. So it impacts everything. So you sort of get this spiral of it feeds on itself over time. And we're really only in the early stages of this. You and I are not saying we are in a recession today. We are saying we are going from a much higher level of growth to a lower level of growth, and it will work its way through the economy in many ways. The big one, Jeb, that people feel, let's talk about the stock market.
Right.
We talked about the wealth effect.
Mm-hmm.
When people have their 401k, hey, I've put in $8,000 a year for the last 5 years, there's 40,000 in there. But over the last 4 years, the market's doubled. I've got $80,000, $90,000. They feel really good about themselves. Someone who only makes $60,000 a year might have $100,000 in that account. And last year, if it went up 25%, 20%, we're talking $16,000, $18,000 extra that they feel like I didn't need to come up with. Now we get a negative wealth effect when the markets are not doing well. So just over the last 60 days, the market, we got a Trump bump through November, December, the first part of January.
Wow, look at that. Little coined phrase?
No, the Trump bump is a known thing.
I've never heard it.
You're not watching enough cable news, Jeb. You got to focus on the cable news. So over the last 60 days, we've seen a big reversal of that. The S&P is down about 8%. The Dow is down about 6%, and the NASDAQ is down about 10%. The big thing, we talk about the Magnificent Seven, those 7 stocks that have powered the market, they've gotten obliterated. So if many of you who were in those stocks in a more concentrated, you didn't buy the S&P, you didn't buy the NASDAQ, you went literally, there's an ETF that trades the Magnificent Seven. If you were in that, you're real unhappy and you're feeling much less wealthy now than you were 60 days ago. And that also translates into the economy. It sounds crazy, even if it's in my 401k, which I'm not, I'm 52. I couldn't touch it if I wanted to for another 7.5, 8 years. But the fact that it's there and it's growing, a lot of people hey, what if I don't save this year? What if I didn't max out my 401k this year? Why do I care? There's $300,000 in there and the market's going to go up 15%. That's $45,000. That's way more than what I can contribute. So if you're a first-time buyer and you're 30 and you don't have a 401k balance like that because you haven't been contributing for 25 years, that's not to make you feel bad. It's to tell you that you'll be impacted by that as 40, 50, 60-year-old consumers behave very differently because of that wealth effect.
Yeah. And I mean, we're seeing it, you and I had the conversation yesterday, Josh, Warren Buffett basically selling a lot of stocks, a lot of long-term positions he's had, getting rid of Berkshire Hathaway, like a lot of different things, right? And makes you question, the market in general, right? I choose not to look at my stock account, my portfolio really regularly. I look at it maybe once a quarter just because at the end of the day, it doesn't really matter. It's there, nothing I can do. Somebody else is dealing with it. And I recommend anybody that owns a house do something similar, right? Don't pay attention to your house price every single day. It doesn't really matter what the value of your home is on any website out there, because at the end of the day, unless you're selling it, it has zero impact. But with that, Josh, a lot of volatility out there in the market, which leads us into the VIX, right? The VIX is an indicator that measures basically volatility in the market, right? So when there is craziness happening, crazy news stories, things impacting the stock market, the bond market, the VIX tends to be at a higher level versus when everything is status quo. Everybody feels really confident, doesn't feel like we're, mass, ups and downs and all that. The VIX is low. And so the last couple of years or so, we've had a pretty volatile VIX. How does that impact, or is that an indicator of a recession?
So it's been above 20 for the last 11 trading days. And you go, cool, 20. What in the world does 20 mean? Well, it means that we're coming off of a period. 20 is not all that high, but it's definitely elevated relative to where we are. So it's not like during the early days of COVID, that was 3, 4, 5 times higher than that, because the market is very volatile, because no one knows. Complete and total uncertainty. What does tomorrow bring? Is COVID going to kill 80% of the population? Like literally, that's when you get ultra high levels in the VIX. So right now it's absolutely elevated. And most importantly for me, what it tells us is that period of really low volatility where everyone felt pretty good. Hey, I know what tomorrow's going to bring. Everything's going to be cool. Stay fully invested in the Magnificent Seven and we all make a bunch of money. That period is behind us. So when we have this elevated level of volatility, oftentimes it can translate to an increased demand for bonds. We haven't seen that flight to safety, flight to quality yet. We're going to get a Fed meeting here, a Fed announcement here shortly while we're recording this, so a week or so before you guys are listening to this. But they're going to come out and they're going to give us their take on what happens and what comes next. And that could be a trigger. You and I both believe that bond yields are going lower in the near future, possibly significantly lower, not guaranteeing it, but that would be a natural outcome of this volatility. Bonds are less volatile than stocks. So you see money come out of stocks, rotate into bonds. That increased demand for bonds with a limited supply increases the price and lowers the yields. Long way of saying for you, lower interest rates as a buyer. So the outcome of this should absolutely be lower interest rates for someone who is comfortable in their life, finances, job, and decides to buy. Obviously a good thing. We would all rather have a lower interest rate rather than a higher interest rate. And it's most likely coming as a result of this elevated level of volatility.
In fact, everything we're talking about today impacts that VIX, right? And most importantly, probably over the last 60 or so days, actually probably since November, Josh, trade, the trade war, this idea of tariffs between different countries, and that impact on not only the market, but inflation, everything has not only impacted the VIX, but just impacted our market in general. So let's talk about, there's still a lot of unknowns out there. We know what we've done so far. We don't know what the true impact of any of this is going to be until probably 6 months, 8 months, hell, I don't know, a year down the road. I mean, I don't know how long it takes for this stuff to feed through the economy and actually show up in reports. We're still waiting on data from 2 years ago of declining rents to impact, the actual shelter numbers out there for, but that's another story. So this stuff takes time to trickle through the economy. What are we looking at right now, and what kind of impact is it having?
So let's file this one under, there is a measure of just about everything. I didn't know this, but there is a Baker Bloom Davis Trade Policy Uncertainty Index, and it has reached an all-time high, aligning with other periods of significant economic distress, such as the 2008 financial crisis and the 2020 pandemic onset. So right now, we all know that there's a high level of uncertainty due to the tariffs and trade. This tells us that it's basically at the highest level. And it just tells us we don't know. Could it be a good thing? Trump's convinced it's going to be a good thing. Does he really intend to do it? Is it just a bargaining chip? Going through the numbers, it will be, so there's this debate, is it inflationary? Well, it's inflationary in the short term. In the first year, you have a new reset to higher prices. Over the long haul, if we don't increase those tariffs, then they stay flat. But at a minimum, an increase in prices going into a slowing economy tells us the economy slows more. It's a further break on the economy, which is not a good thing. I mean, you may get here, okay, cool. If it slows further, then rates go lower. I get a better situation. Well, again, the economy slows more people lose their jobs. People that keep their jobs earn even less in terms of less discretionary pay, overtime bonuses, commissions, any and all of that stuff. So there's a balance here, right? We truly do want a Goldilocks economy economy. We want low inflation. We want growth, but not too much growth, because then that causes inflation. You want the stock market to go up, but not so much that you get a bubble that it reverts and you get this crazy up and down volatility. So all of these things are telling us that we need to be alert and aware that we are in a shifting economy that's downshifting. Is it downshift all the way to a recession? May or may not. Probably will at some point in the next 1 to 2 years, but it will be very different than the last 2 years have been. And you probably didn't want to hear 15 minutes on all this economic stuff. If you're here on a home buying podcast, you're going to say, how is this going to impact me? So that really is where we need to transition the conversation, Jim.
Yeah, and recessions, Josh, they don't just hit Wall Street, they hit Main Street, which is you guys out there listening. First-time home buyers, people trying to get into a home, maybe get into their second home. That's who is impacted by all of this. So we're going to take some time here and go through it and hopefully help you guys become educated home buyers. But before we do that, if you find any value in this podcast at all, do us a favor. Hit that thumbs up, subscribe to the channel if you haven't done so already. And if you're following us on Spotify or Apple, make sure you leave us a review. That's how people find us. For that, for all the support and everything that you guys have done so far, we're very appreciative. We just want to continue to keep that momentum going and create first-time home buyers, educated first-time home buyers, rather. So, Josh, the best thing that could happen with any recession, at least in my eyes, is the idea of falling interest rates. Now, we talked about there is a downside to falling interest rates, or a downside to a recession, and that it does impact people, employment, and that sort of thing. But for those that continue to maintain employment, continue to kind of keep going, moving forward, falling interest rates are a huge benefit. So how does that impact us?
Well, let's touch on both parts of that. You want to benefit from the lower interest rate, so you hope that your job, your income is not impacted. So if we look back to the great financial crisis, at the worst levels, unemployment was in that 12, 13, 14% range. We're at 4% right now. There is no world in which we're going back to 12 to 14% unemployment. So some of the worst figures that I've seen, projections say we could get to 8% in the next couple of years. So that means we have twice as many people out of work as we have now. So most of you are not going to be impacted if you're young, professional, upwardly mobile, valuable at your job. And that doesn't, we're not sitting here thinking of, corner office executives. I mean, everyone, a middle manager, someone who is blue collar out there, doing plumbing and electrical work, doing framing work on a job site. All of these people, if you are good at your job, if you show up and give an honest day's work, which most of the people in our audience are, when we talk to them, hey, I've got raises here, I've got promoted, whatever that position is, they've got to a point because they work hard and show up. So they're less likely to be impacted by this. But that being said, I'm sure we all know someone who's a great person, smart, good worker, and is out of work right now. And I'm not just talking about government workers, Jeb. So from that perspective, as long as you're not in that group that is impacted negatively income-wise, you will benefit from lower interest rates. And lower interest rates are an absolute certainty in this. And people talk about stagflation, and okay, you could have high inflation, low growth, and it leads to higher interest rates, and the Fed can't do anything. Like, that's a once in a lifetime event. I'm not in this sticky inflation, persistent inflation camp. I don't believe that. Don't believe that thesis. I believe that inflation is currently much lower than what our measures are reflecting. Not that anyone's cooking the books. It's just, it takes time for it to catch up. And if the economy keeps decelerating, you're going to see inflation continue to go down and interest rates go significantly lower than they are right now.
Yeah, and that's a benefit. But on the flip side of that, Josh, lending standards can get a little bit stricter, right? Well, I'm already seeing it, and I'm not even on the mortgage side, right? On the real estate side, condo complexes, more, at least that's where I'm seeing the guidelines become more sticky or stricter, rather. You can add anything into that if there's something else. But, looking deeper into condos, I had one go from a warrantable condo to a non-warrantable condo. That created issues with the buyer in the middle of the process, right? And it was the Wall Street Journal or one of these put out some article 2 days ago about the blacklist, these properties on the blacklist. And I'm like, blacklist? What the hell? So I read the article, and no, it's just that the property is unwarrantable. It doesn't mean that it's on blacklist, that it can't be lended on. It's just a different lending program. It becomes a non-QM loan, means different guidelines, different rates, it's just a different deal. So if that continues to happen, banks are probably going to get a little bit more strict. That doesn't mean banks aren't going to lend. There's people out there saying that banks aren't going to lend if we Not true. Banks will continue to make loans. There will be, people out there continuing to buy homes. It's all going to happen. It's just it's a change, right? And people don't like change, but unfortunately, it's just part of the process.
Big picture, Jeb, for me, here's how I see it. We relate and refer back to this. Bill McBride over at Calculated Risk over 2 years ago wrote an article, 7 Years in Purgatory. And he's saying anyone hoping, dreaming, expecting, building a YouTube channel based off of the idea of a housing crash, housing bubble is out of their mind. But by the same token, says anyone thinking that you can have the appreciation that we had over the last 4, 5, 6 years, that we can get to an affordability level that we're at right now and still have continued rapid appreciation going forward, also is likely to be disappointed. So what he's saying is expect, and there's nothing magical about 7 years. He says, 5, 7, 10 years of flat home prices. And they have flattened over the last couple of years, but they haven't been flat. They've still been up 4 or 5%. So, I don't think anything about this changes. If you have a slowing economy, increasing unemployment, lower wage growth, yes, there are plenty of people not impacted by that are still going to buy, that will create demand. Those people are going to have a little bit of a tailwind in terms of lower interest rates. But I don't rule it out, but I have no expectation of 3% interest rates anytime in the next 5 to 7 years. So if home prices are the highest level and we went from 3 to 7 and we come back to 4.5, that's still a 50% higher interest rate than the people that bought on the front end with the low price and the low interest rate. So we do have some things here that can be construed as tailwinds for buyers, but we also have things that are headwinds that are not going to go away. And I think that's what Bill was hitting at in that article is I would expect relative stagnation here. So what doesn't change is if you are of home buying age and you were in college when COVID hit 5 years ago, and the time for you to buy a home is when you get married next year, and then the year after that, you want to buy a home, you say, okay, I don't get to control what the economy is. I don't get to control where home prices are, where interest rates are, but I have wanted my whole life to be a homeowner and to raise my family in a home that we own and get that paid off over my lifetime. That drive is never going to go away. So it really comes down to, I don't know that a whole lot changes. Everything changes because it's happening to you personally, right? If you're buying in 2026, you don't care what buyers in 2024 were going through or necessarily what buyers in 2030 are going to go through. I would expect that there's going to be challenges. There's going to be some changes that will benefit you. But if your life plan includes owning a home, hopefully you're on the side that is not unduly impacted by the economy, and you are able to benefit from the downsides of it. And I say that, Jeb, probably some of the home equity wealthiest clients that I have are the ones that were able to buy in 2010, 2011, 2012, sure, 2013. Those weren't great years for the housing market. They were great years to get into the housing market. So from that perspective, every challenge also presents an opportunity.
No, absolutely. And we talked about this, or you briefly mentioned it when talking about Bill McBride and the article of 7 Years of Purgatory. But let's talk directly about home prices, right? Less demand out there in a recessionary environment for the most part. At least that's the thought. But when you look back at recessions, historically speaking, home prices typically don't decline during recessions. So what's the likelihood, or I guess not even forecasting, home prices? I guess it is a forecast. Either way you look at it, what's the thoughts on prices going forward?
So we got numbers, and I meant to put them in here in my notes. We got numbers out of the CAR, California Association of Realtors. It was yesterday, maybe the day before, showing that sales went up. So sales have increased, but still not elevated. They're down from where we were in the state of California. We were over 300,000 a year for a number of years. We're still well under 300,000. But that tells you in one of the least affordable states in the country that we have seen an increase in sales volume. So there's still demand out there. People still want to buy. What are we seeing? Are home prices going up? When prices going up, that's an increase or sales going up. That means there's more demand, more transactions, right? No, they're not. It was like the lowest monthly increase in home prices that we've seen over the last 3 or 4 years. And I think we just continue to see that. I think you see slightly increasing home sales volume. And as a buyer, you don't care how many homes sell. I think we will see continued minimal increases to sales volume and minimal increases to home prices, just because we're kind of tapped out on affordability of what people are able and willing to pay for homes, and that supply demand balance. Sellers don't want to sell into a market where they don't get a number that they want or can find something to replace it at a number that they're happy with. So we have limited supply, but we have limited able demand of people who are willing to step into the current market. So for me, continued low sales volume, continued very low appreciation. I think we're going to have a few years under that long-term average of 4%. We haven't really seen it yet, but this year is probably the first year, and I would expect it for 3, 4, 5 years, which would be a healthy thing.
Yeah, and at the end of the day, it really depends on rates, right? If rates move a lot lower than we're talking, that those numbers are going to be skewed to the high side. And if rates were to go move back higher, then obviously it's going to have a much bigger impact in limiting potential for sales as well as appreciation.
And you tell me if you feel differently. For me to really ratchet up that forecast, I need to see rates under 5%. If we hit 5.75%, 5.5%, it's going to be a more robust market. And towards the high end of those projections, maybe you see 3, 4, 5% appreciation. But to really blow things out of the water, where you need to be to get back to 5 million existing home sales annually, where you need to get back to over 5, 6, 7% appreciation, you would need rates, under 5% to get to what you would call a hot market.
And one of my mentors thinks it's 5.8%. So thinks it's a little bit higher than your forecast because the study is based on new home builders and what they were able to do when rates were 5.8%, or it basically stimulated growth at that time. So but
it wasn't stimulating growth. They were able to move their product.
Well,
they were able to. So what I'm saying is at 5.75, at 5.5, we have a robust market, more robust than what we have right now. But to get a really hot market where people fear, how many times
I don't want a really hot market,
but I don't either. But you know what I'm saying? How many times do we hear buyers wanting to get in the market and they're like, I want rates to go down, but I don't want them to go too much, because then we get bidding wars and prices go up and everything again. Before we get to that, I think you need rates under 5% to really make a hot market where it is uncomfortable for buyers. So really that Goldilocks is anywhere from 5.5% to 6%, where it feels better in terms of affordability, but you're not getting squeezed by 900 other buyers also interested in the same house that you want.
So Josh, with everything that we've just talked about, we're talking to first-time home buyers. That's our primary audience here. So what should they be thinking about recessions, home buying? How can they prepare? Let's talk about it.
Absolutely. Do your prep. So what does that mean? It means talk to a lender. Remember, we talked about this. Where should I start? I don't even think realtors would object to this, because what is a realtor happier with? A new buyer or a new pre-approved buyer? It's like having a gift wrapped buyer. So from that perspective, talk to a lender. If there's anything in there that you need to work on, is there anything funky in your job or employment or income history? Is there anything in your credit record? Is there anything we need to move some money out of crypto into a more liquid asset? Any number of things that can require prep work. So never too early to talk to a lender. From the standpoint that now you can get a game plan to execute over the next 3, 6, 12 months, 24 months, whatever the plan is. We just closed one for Ben and Sam out in Phoenix. Talked to them 2 years ago. They went and executed the game plan, popped back up. 2 months later, they're in a home. So I say, do your prep, monitor the market, know your market. Who cares? I don't care what the national market is doing. I want to know in my market, my city, my zip, the neighborhood that I want to be in, what homes are coming on the market, how quick are they selling? Are they selling at or below? Is there a discount? Is there a premium? All of that stuff. Get to the data and know your work, and then know your circumstance. We talk about, is it the right time in your life to buy? Have you reached that stage in your career? Well, maybe that's more important to focus on right now. I've had a couple of people here recently that have government jobs or government ancillary related jobs, and they're like, I'm putting this off for 3 months. With everything going on with the new presidency, I don't know. And I go, that's a brilliant idea. This is a too big of a decision to rush into. So know what's going on with your company. Don't bury your head in the sand at work and go, hey, I'm awesome, so I'm going to be cool. You can get blindsided by something bad from your company in a slowing economy. But from that perspective, Jeb, I will go back to your saying, control what you can control, do what you can do, prepare, educate, watch the market, pick a team of pros, and make the best decision for you to enter the market at the time that is right for you.
And if our team can be of any assistance to you, there's a link in the description of the video where you can talk to Josh and the team to get pre-approved. If you have questions, we can just walk through those questions. And if you're looking for a real estate agent, regardless of where you're looking in the country, we can guide you through that process as well. But my I guess my advice is nothing wrong with waiting, right? If you think a recession's coming, you want to wait, that's okay. But the grass isn't always greener, right? So expecting some crazy outcome just because you think the market's going to slow, I don't think is reality. I think there are benefits to a recession, but I also think there are downsides to a recession as well. But at the end of the day, you have to do what's best for you. But with that journey, we're going to continue to educate you. So show up every week, and we'll be, and we'll provide a guidance, to help you become educated home buyers. So if we can be of assistance, make sure you reach out. But until next time, adios.
Amigos.